A good quarter bought you nothing this week. The companies that beat got sold. The one that missed got an activist who wants the CEO's job. And the biggest checks anyone wrote were for assets that don't pay off until the 2030s. $18 billion of biotech changed hands inside 72 hours. Nobody was paying for the quarter, they were paying for the next 5 years. So today, two beats that got punished, one miss that turned into a proxy fight, and three companies on the same page of the memo making three incompatible bets on the same decade. Telltale's Weekend Update. I'm Ava Cabot with Marcus Graham at the Cash Flow Desk. AMD delivered about as clean a print as semis produced this quarter, and the market took 7% out of the stock for it. Revenue $11.5 billion, up 52% year over year. Gross margin 54. Net income $2.3 billion. EPS 130. Then the Q3 guide landed at $13 billion at the midpoint, above consensus. Beat, and beat. Down 7. Marcus, what did they actually get punished for?
Not the quarter, the price of admission. The memo had AMD at 88 times trailing free cash flow going into this print. Q1 10 court confirmed on $8.7 billion of trailing free cash flow. We re-anchor when the Q2 10 court files. At 88 times, you are not buying a beat, you are buying years of uninterrupted acceleration. And Gene Hu just told you the data center step-up is second half weighted. Second half weighted means the proof shows up after the multiple already has to hold. That's the part that got sold.
And in the same week, they went shopping. AMD agreed to buy Talos, a Canadian startup, to add another category of AI silicon for the data center. Marcus, is that a company that thinks it's ahead?
It's a company hedging its own roadmap, which is the correct thing to do and an uncomfortable thing to watch. Going into this print, the memo had AMD running $1.2 billion of capex, trailing 12 against under a billion of buybacks. Q1 10Q confirmed, and that was before Talos. Lisa Su spent the week praising Elon Musk after SpaceX committed to NVIDIA exclusively. Buying a second accelerator architecture says management does not believe one roadmap wins this market outright. That is honest, and it is the opposite of what a multiple in the high 80s is underwriting. The test is whether the Talos silicon shows up in a customer deployment before that multiple has to be defended again.
Gracious in public, hedging in the checkbook. CVS beat the quarter, raised the year, then said one thing about 2027 and gave it all back. Adjusted EPS guidance up to $7.90 to $8.10 from $7.30 to $7.50. $2 billion of costs already out the door, stores closed, leadership reshuffled, and then a preliminary look at 2027 profit that disappointed, plus a warning about the pharmacy benefit business next year. Shares fell. Marcus, 12 months of execution against one sentence about a year that hasn't started.
On this balance sheet, the sentence should win. The memo had CVS at 16 times trailing free cash flow, going in Q1 10Q confirmed, carrying 7.5 turns of debt to free cash flow. That leverage is what makes a 2027 comment expensive. A levered turnaround gets paid for the trajectory, not for the print. What would change my view is the pharmacy benefit line holding through next year's renewal cycle. If it doesn't, the deleveraging slides a year to the right, and the multiple is the thing doing the waiting.
And then Celsius, where a missed quarter turned into a job application. Q2 revenue $818 million against consensus of $870. GAAP EPS down to 14 cents from 33 a year ago. The core Celsius brand shrank about 12%. Alani Nu retail sales grew 56. So the growth is real. It's just not the name on the can, and it's not the name on the building. Adjusted EPS came in at 36 cents, so the operating business is not broken. What's broken is the story that Celsius, the brand, is the growth engine. Then Friday, Russ Savage, the man who founded Rockstar Energy, disclosed a 4.7% stake, more than 12 million shares, and said the board should replace CEO John Fieldly with himself. Nobody buys 12 million shares of a company to relitigate last quarter. He's buying the next 5 years of a portfolio he thinks is being run by the wrong person, and he built a competitor in this exact category before he bought a share of this one. Page 15 of the cash flow memo is pharma and biotech, and this week 3 names on that one page made 3 completely different bets on the same decade. Vertex is buying. Lantheus is being bought. BioNTech is shrinking. Vertex beat. with Q2 revenue of $3.3 billion, up 12%, raised full-year guidance to $13.1 to $13.2 billion, and agreed to pay $10 billion in cash for Crinetics at $85 a share. Lantheus agreed to sell itself to Curium for up to $8 billion, $102.50 a share in cash at closing, plus up to $12 a share in contingent value rights, closing in the first half of 2027. And BioNTech cut full-year revenue guidance from 2.5 to 3.1 billion euros down to 1.6 to 1.9, named Guido Ulkers to replace co-founder Ugur Sahin as CEO, and said it will close manufacturing sites affecting up to 1,860 jobs while authorizing a $1 billion buyback. Marcus, 3 answers to the same question. Which one is the market getting wrong?
Lantheus, and the spread tells you where. The stock closed the week around $101 against $102.50 of cash at closing. That's a market saying the deal closes and pricing the $12 of contingent value rights at approximately nothing. In radiopharmaceuticals, the milestones are clinical, not commercial. A CVR with no bid is the market's statement about what the buyer thinks it's getting and what the seller could never prove standing on its own.
Free option, no bid, and Vertex is standing on the other side of that trade.
Vertex is paying cash for a pipeline it can't sell for years, and it can afford to. The memo had Vertex at 30 times trailing free cash flow going into the print. Q1 10Q confirmed on $3.7 billion of trailing free cash flow. $10 billion out the door against that clears without touching the debt line. We re-anchor when the Q2 10Q files. What I'd watch is whether the raised guide survives the integration year, because a company that raises the year and writes the biggest check in its history in the same week is telling you the core franchise is funding the option, not the other way around. BioNTech is the one nobody wants to look at, and it's the most honest of the 3. Going into this print, the memo had them at 7 times trailing free cash flow at a 14% yield. Q1 10Q confirmed, and those are euros, translated in the memo at today's rate. That is a market that has stopped underwriting a future at all. Having the guide, closing plants, and authorizing a buyback is management agreeing with that price. I'd weight it as a rational retreat rather than a value trap, but the two look identical until the oncology pipeline delivers data.
So what does page 15 actually say this week?
That the discount rate on a biotech pipeline is being set by somebody other than the public market. Vertex at 30 times trailing free cash flow and BioNTech at 7 sit on that same page, applied to the same underlying activity, finding molecules that work. Curium is private capital, Vertex is a strategic, and both transacted above where the tape had the asset marked. When the price setters on a page are a private buyer and a strategic buyer, the listed multiple stops being the opinion that matters. What would flip that is the Lantheus CVR trading with a real bid before the close.
Same page, same week, same disease franchises. One company spent $10 billion buying a decade. One took $102.50 a share to hand its decade to somebody else. One said out loud that it doesn't have one to sell. 3 managements priced their own optionality in public inside 72 hours. The earnings reactions were the small part. Rapid fire. ConocoPhillips posted its best profit since 2022 and used the same press cycle to change CEOs. Q2 earnings of $3.23 a share. Ryan Lance is out after 14 years into a transitional executive chair role. CFO Andy O'Brien becomes president and CEO September 1st, with Connie Haynes-Welsh moving up to CFO. Going into the print, the memo had Conoco at 9 times trailing free cash flow at a 10.8% yield on $18.5 billion of trailing free cash flow. That trailing 12 carried $4 billion of dividends and $4.5 billion of buybacks. Handing a franchise returning that much capital to the finance seat at the top of the cycle is a choice. The thing to watch is whether the return pace survives the handoff, because a new CEO who came up through the CFO's chair has every incentive to build a war chest in his first year. Harrow bought a product 4 days before it has to explain itself. Definitive agreement for the global rights to Tyrvaya from Viatris, $30 million upfront, up to $70 million more in milestones tied to net sales. Tyrvaya is the only FDA-approved nasal spray for dry eye disease. On page 20 of the memo, Harrow sits at 46 times trailing free cash flow with 8 turns of debt to free cash flow. Q1 10Q confirmed, and Harrow reports Monday consensus at a 23-cent loss on $70.4 million of revenue. A levered specialty pharma company buying a commercial asset the week of its own print is either conviction or timing. Monday says which. Also on page 20, Uber grew gross bookings 22% and non-GAAP operating income 40%, then guided Q3 light and dropped 5%. The same week, it committed more than $10 billion to a robo-taxi aggregator strategy. And Airbnb beat and raised full-year revenue guidance to at least mid-teens growth, with the stock up 15% on a World Cup travel surge. Brian Chesky says the company will spend a lot more on AI this year because inference came in cheaper than he budgeted for, which is a CEO announcing his own forecast was wrong in the happiest available way. Two more. Palantir grew U.S. commercial revenue 149% to $764 million, total revenue 93%, raised the year to 82% growth, and put up 29% in a single session. The memo had it at 102 times trailing free cash flow before any of that. Q1 10Q confirmed, 102 times. Alex Karp's line on the call was that his customers have, quote, declined to become vassal states of the language labs. Nobody has ever sold sovereignty harder, and at 102 times, nobody has ever needed to. And Disney beat on fiscal Q3, sold its 50% stake in AE Global Media to Hearst for $1.2 billion, and signed a global short-form content deal with TikTok. 3 storylines, 1 week. Disney is selling the cable asset and renting the attention. Forward calendar, Harrow Monday, Venture Global Tuesday, then the consumer block the week after, Home Depot Tuesday, Lowe's and Target Wednesday, Walmart and Deere Thursday. 5 names, 3 days, and the whole picture on household spending. That's the show. A good quarter bought nothing this week. Wall Street's consensus on earnings season. A beat gets bought. AMD beat on revenue, profit, and the guide and lost 7%. CVS beat and raised and gave it back on one sentence about 2027. Consensus is still grading last quarter's tape. What actually got paid for this week was the 2030s. $10 billion for Crinetics, up to $8 billion for Lantheus, $100 million for a single nasal spray. The prints were the receipts. On Wednesday's episode 2632, Hunt, Jason, and Mike took Harrow through the AI and healthcare segment and landed on it as a commercialization business, one where AI isn't the deciding factor. 4 days later, Harrow went out and bought something to commercialize. Hunt, Jason, and Mike are back Wednesday on episode 2633. Download the memo at telltales.us, 20 pages every week, and send us feedback through the Substack. Every note gets seen. The show is produced entirely with AI tools, and both voices you're hearing are AI generated. The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase, or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.